Ladies and gentlemen, good day and welcome to RBL Bank Limited Q2FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. R. Subramanya Kumar, Managing Director and CEO of RBL Bank. Thank you, and over to you, Mr. Kumar.
Thank you, ma'am. Good afternoon, ladies and gentlemen. Thank you for joining us here on a Sunday afternoon, especially during the festive season. We truly appreciate your time and presence. Yesterday was a landmark day for RBL Bank. We announced a historic strategic transaction, which I will speak about shortly. But before that, let me briefly touch upon our second quarter results, also announced yesterday. Over the last several quarters, we have stayed focused on strengthening our balance sheet through granularization of both advances and deposits, and by optimizing our retail mix. I am pleased to say that this journey continues steadily and with discipline. During the quarter, our advances crossed 1 lakh crore mark. The secured business loans now above 10,000 crore, and secured working capital and finance portfolio crossing 2,000 crore and 3,000 crore respectively. Our secured retail and commercial SME businesses continue to grow healthily. The wholesale banking remains a key growth driver, contributing meaningfully to advances, low-cost deposits, and profits. Our branch-led retail asset business is scaling up well, with over 60% of the leads now sourced from the branches. In fact, our entire organic gold business originates through branches, helping us to keep the acquisition cost low. On the liability side, the granular deposits have grown consistently, from around 43% a few years ago to about 51% today. Term deposits below 3 crores have grown at a CAGR of 21% over the last 3 years. We have consciously de-risked the portfolio. The secured retail loans now form 34% of advances, while unsecured retail has reduced from 34% to around 26% over the past 6 quarters. The strong underwriting has kept net slippages near zero in wholesale and secured retail segments, which together account for nearly 3/4 of total advances. The MFI portfolio is normalizing well, and we expect it to return to pre-COVID levels of stability soon. The credit cards, however, remain an area of the focus as we address stress in the older vintages. Our retail secured products, which have been in the investment phase for the last 2 years, have now turned PBT positive as a cohort. And we expect all the segments barring prime housing to contribute to profitability by year-end. In short, the bank is well positioned for consistent, profitable growth with a stronger and a more diversified balance sheet. The foundations we have built, the granular liabilities, the balanced retail portfolio, the branch-led origination, and improving cross-sell intensity will continue to anchor our strategy. Now, turning to the important announcement on the transaction that we announced yesterday. Emirates NBD, the second largest bank in the UAE, and the leading financial group in the MENAT region, will invest approximately $3 billion through a preferential issue, subject to shareholder and the regulatory approvals. Acquire a 60% stake in RBL. This will also trigger an open offer as per SEBI guidelines. Post completion, the Indian business of Emirates NBD will merge with RBL Bank. This infusion will take our net worth to around 42,000 crore and position us among the best capitalized banks in the country. It enables us to accelerate growth across our existing businesses, invest meaningfully in technology, brand, and distribution, to create a stronger and more diversified income streams. Kiran's NBD brings not only the capital, but also the deep global banking expertise, digital innovation capabilities, and access to the vibrant trade corridor between India and the Middle East. This partnership marks the beginning of a new chapter for RBL Bank, a transition from stability to sustained growth, from selective participation to the leadership in chosen segments, and from being a mid-sized Indian bank to a future-ready institution backed by one of the most respected financial groups in the region. We believe this transaction will create a long-term value for our customers, employees, and shareholders, and reinforce our position in India's fast-evolving banking landscape. Thank you, and thanks once again to all of you for coming on a Sunday afternoon. Yeah,
we can open up for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rikin Shah from IIFL Capital. Please go ahead.
Good afternoon, sir. Am I audible?
Yes, Rikin.
Okay, congratulations team for the landmark deal. Really fantastic. I had a couple of questions to begin with. First one, just wanted to understand how the net worth would look like after the press offer and the amalgamation is done. Is it broadly around 44,500 crore, 42,000 crore, 44,500 crore on day one? So maybe whenever the deal gets consummated, the new net worth would be around 44,500 crore. So that's the correct understanding, right?
Yeah, around 42 to 44 in that range.
Including the branch merger, 44,500 roughly, yes.
Okay, got it. Second, I mean, this is, abundant capital, which probably means that you wouldn't need capital for next 5-7 years. Curious to understand, early days, but what is the capital allocation plan? When with this capital coming in, will you be thinking about retiring some costlier cost of funds or make some inorganic acquisitions? How should we think about this allocation of capital? Because the eventual deployment to the loans will happen only over a period of time. So over the next couple of years, what could be the allocation plan for the bank?
So I'll give a broad sense. The details of it we can work and then discuss subsequently after the transaction is consumed. So broadly, we first scale on the existing businesses because all these businesses which we have already implemented has the clear growth path. So we will be in a position to scale that. That is one. The second, there are some new opportunities which will open up because of this particular transaction, and these new opportunities are likely to be in the VNR business and the cross-border payment, cross-border transaction, and trade business, and it will also open up our ability to do competing or competitive land space of the corporate business. We will be able to do more business for those corporates who are from these geographies doing business with us. And we will be in a position to do more corporates who are doing corporates of India who is doing business in those regions. So this is a new opportunity which is growing up. Those will be the additional allocations which will happen. However, the details of it we can work out. Jaideep, you want to add something?
Yeah, and Rikin, I think on the liability side, clearly we will not stop the retail engine growth of deposits and especially low cost deposits. What might happen is, of course, the need to look at any long-term foreign currency borrowing, etc., will dramatically come down, and there might be some retirement of liabilities. But the core banking business is not something that we will, want to compromise on.
Good. And a few more follow-ups on this. So, given Emirates' own credit rating, the rating of its fully owned subsidiary in India, which I think is also AAA, would you expect credit rating agencies upgrading the rating for the bank from AA minus? And if that were to happen in two scenarios, let's say if it gets upgraded to AA plus and or AAA, what is the incremental delta on cost of funds that one can potentially see if that were to happen? So that's number one. The second one, if you could talk a bit more about the current business of its wholly owned subsidiary, how big is it, how complementary in terms of the loan book portfolio vis-à-vis RBL Bank currently, if that were to be integrated, what could be the IT or employee integration challenges, if any? That would be the second one. And I have a couple of others. If you allow me to, I'll ask them, or else maybe I'll come back later on the call.
So the second question I'll answer. First one I'll ask Jaideep to give the details about it. They are working on a technology platform similar to us. So the question of merging the branches into the RBL may not be a big challenge, number one. Number two, they are mostly into the corporate banking, and very few accounts, or some few accounts are common in us, and they're consuming that and taking it forward may not be a big challenge for us to work with. With regard to that other point.
Yeah, on cost of funds, cost of borrowings, I think yes, we would definitely expect the rating upgrades to happen. But today, if we look at our cost of deposits, I would say give or take, we are maybe 1% or so higher than, let's say, the large private sector banks. And I would expect that gap to materially narrow over time.
Jaideep. And if I can just maybe squeeze one more question and then perhaps I'll come back again. How should we think about the pro forma financials for next couple of years, given there are multiple moving parts here? Of course, given significant capital coming in, the leverage goes down and ROE gets down, but ROAs will also materially move up. So any guidance on how to think about the potential financials in FY27, 28 would be helpful.
No, Rakin, it's a little too early to comment on the specifics that you're asking. But directionally, of course, as you rightly said, ROA will materially expand given the large inflow of equity. And ROE will be a function of getting a reasonable leverage on the books over the next couple of years after that. But given the very strong expansion in ROA that happens, we would expect close up to a reasonable levels of ROE, respectable levels of ROE within a couple of years.
Got it. And just one last data question on the quarterly result. I think I saw that there was 44 crore of some adverse M2M impact. If you could elaborate on that, what was that? Will be helpful.
Yeah, I think we are holding Utkarsh Small Finance Bank, the holding company, which subsequently will get merged. They declared, because of ECL considerations, the holding declared a reduction in net worth, and that resulted in a mark to market, which happens once a year based on the audited financials of the investee company, of the holdco, and that is what resulted in a reduction of about 40 crores.
Any potential further implications from this particular investment, or this was one time?
We don't expect anything more. Yeah.
Got it. Perfect. Thank you, Jaideep, and thank you, Kumar sir.
Yeah, thanks.
Thank you.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So, again, related to the deal in terms of the completion of the capital, how frequent would that be, and maybe in terms of the growth acceleration from here on? Obviously, the capital would rise like almost 2.5 threefold. But in terms of the growth acceleration, how should we look at it? Or maybe we will look more at inorganic opportunity, because the entire machinery, I think we need to invest a lot into the machinery to get to those kinds of growth levels. So ideally, how much time would it take for capital to be adequate to consume, and any inorganic plans?
See, right now, when you look at the opportunities, we don't say that the opportunities for inorganic cannot be ruled out. Yes, it is also the one more. First, we are working out very deeply with regard to the organically how we can consume and grow multifold. Today, our capacity, which we have built it in respect of all the businesses and as well as the delivery machinery, will facilitate us to achieve a fairly higher growth level than what you have been seeing it for the last couple of quarters. So this is one. The second is that as we grow to our capacity, the capacity build-up will take place. Since we were able to establish all the product line, it is a question of only location and expanding it. That should not be a big challenge given our streamlined processes of capacity building. Within the 2 quarters, after the consummation of and other things, the growth will be accelerated. Thereafter, with additional capacity, which is thoroughly done with, we'll be able to give little more accelerated one. Meanwhile, we don't rule out the opportunity for the inorganic, which we'll keep looking at it. But it's too early to comment exactly how this is going to fan out. Anything else?
I think, Kunal, one should appreciate the fact that this is an announcement, and I think the transaction consummation itself is a several months affair, which gives us enough time to plan over the next few months. So this is just the announcement of the transaction.
Sure. So got that. So maybe in terms of the capabilities we have, what is the kind of growth? Like today, maybe this possibly some acceleration out there, now getting towards like 15%. But does the existing network and distribution sectors that we have the potential to even grow at 20 or so without immediate investments?
So, Kunal, this is Rajiv. I'll back to that. So, if you see, barring the microfinance and card business, which because of the environment and our own risk adjustment, we have actually pared them down over the last few quarters. The rest of the business actually has been growing quite well. Retail secured has grown between 25 and 35%. And there is more and more opportunity to do that. The wholesale business actually, where the machinery is the most developed, which can actually grow a lot more, and that does not need, a significant addition. And perhaps this is also where, the cross-sell, the ability to do more business will actually become easier for us, not just in the long run, but in the short run too. So I would say these are the natural ones to grow faster as we continue building the capacity on the more granular business in retail. And look, microfinance will come back, okay? And I think by the end of this quarter, cards will also start showing organic growth. So we should see a natural growth of the current structure of the business come back, in addition to what we can do in at least 3 out of the 5 businesses, plus what we can do by build-up of capacity.
Sure. And on open offer, is there any limit? So today the open offer price seems to be almost similar part of the deal price at 280. So maybe is there maybe if we don't get much of an open offer, they wouldn't be okay with just holding 60%. Is there any limit? I think anyway there is upper cap of 74% in terms of higher holding, which might not be cost. But maybe on the other side, is there any benchmark or maybe it can be even like in low single digits, maybe it's like 10 years to the deal size, yeah.
So, Kunal, I think the open offer is a consequence of the preferential. I think the intent here is to look at a 60% pref. And as you rightly said, one would normally not expect anything materially in open offer. But the construct is that there is a minimum 51% that will be taken up by ENBD, depending on the foreign shareholding in the open offer. But the idea is to be at somewhere in the 60% range, plus the branch merger, which will add another 82% to the transaction.
Got it. And the last question is on the right of corporates, particular as well as the MFI. So the accelerated one, this quarter, is it more to do maybe getting close to this transaction wherein there was an acceleration, or is there was any specific? Yeah.
No. This is the absolute business as usual. And that is not going to change even in the next couple of quarters. We have, as I am repeating, this is an announcement. I think the closing consummation of the transaction is going to take its own time. We will be on our natural, normal growth trajectory.
So even micro can be corporate almost in 150 odd crores.
No, that was a very old NPA, Kunal, which had, become old enough for us to kind of do a routine write-off. There's nothing, it's a technical write-off. So there's nothing really to do with...
100% provided already.
Yeah, it's just 100% provided NPA.
Got it. Okay. Yeah, thanks.
Thank you. The next question is from the line of Anand Rama from MG Global. Please go ahead.
Thank you for the opportunity and very congratulations to this deal. First question was that this deal obviously came as a very positive surprise, but what is the rationale behind this acquisition by NBD? We could have actually grown. We were already on a recovery path. Possibly we could have grown on our own with some kind of capital infusion. That is number one. Number two, in the release you have said that there are regulatory approvals that you will require. What will be the sequence of these regulatory approvals, and whether you will also need an approval of NCLT, because there is going to be a merger of the Indian subsidiary of NBD Emirates. Third, the broader construct of the NBD Emirates, given that basically, how do you see the portfolio reshaping for us? For example, we are more of a retail and MSME bank at the point of time, that's of corporate. Do you believe that the portfolio shape of the RBL bank in the future years to come under NBD would undergo a change, and we will actually be more of corporate than more of retail as such? Any other discussions which have happened on that, and if you can share something on that, that would be great.
See, one of the biggest attraction of RBL is the retail franchise and the retail growth story which has been seen and its execution capacity, and at the same time not giving up its ability to grow in the corporate. This is the first basic principle, and the vision with the strategy will be built thereafter. It will be by scale for the existing business and addition of the new business. So coming to your other point of saying that why the capital infusion, why not local growth? See, everybody has a greater aspirations and they're doing it. Given an opportunity, nobody would like to be a small mid-sized bank forever. And you know that small mid-sized bank has its own challenges. And the most obvious reason or most obvious step would be that we wanted to get down to that the larger league or on the top of that mid-sized bank and not call as a small bank, for which the one important ingredient is the capital. When the capital is, either you go in franchise small steps or upfront everything and try to build the building based on that. We thought that getting it upfront and then building all the building blocks are available. It is a question of only scaling. So with this, we will be able to do much faster than what otherwise we would have achieved our desired dream of moving up in the ladder. That's one important factor. And what is the second question?
Yeah, from the approval standpoint, Kunal, it's
Anand.
Anand. So from the approval perspective, the RBI approval and Government of India approvals and CCI approvals. The merger specifically is under the BR Act of 44A, and therefore there will be no NCLT process at all. And that is what is typically with respect to banking companies and branches, gets done under the RBI guidelines.
The first approval will be the shareholders' approval, which will be on the 12th of November. We have called the EGM. Thereafter, all other approvals, what I said, will be applicable.
And sir, the open offer will trigger only after preferential is done, or because I think in the press there was one question, and I think where it got, they got confused that the open offer actually, or you might acquire the stake first from the market and then do actually look at pref. If you can just comment on that.
Yeah.
So Anand, basically, normally, as you know, the pref happens first and then the open offer. In this case, since the preferential issue is 60%, and on paper we have to look at a 26% open offer of the expected share capital. On paper, therefore, the stake can go up to 86%, which will of course cross the minimum public shareholding requirement of 25% to be public. And of course, we are going to be continue to be a listed Indian bank. And therefore, the SEBI guidelines allow under a certain section to actually first consummate the open offer, and depending on the open offer, the preferential and the open offer gets proportionately scaled down. Now, it's a different issue that one doesn't expect anything material open offer, but obviously from a process standpoint, one has to have the ability to do a 26% open offer. And therefore, this is happening in this form, which allows the scale down proportionately of both the open offer and the preferential issue, such that the minimum public shareholding is at 25%. And therefore, the investor goes up to 75 on paper. And then, of course, from 75, the investor has to come down to total foreign shareholding of 74%, which will happen through the scale down of only the preferential issue. That is the structure.
Okay. In that case, first the approval actually will come from open offer, or it will be an open offer in next 1 odd month, and thereafter we can
No. So open offer is after all regulatory approvals. RBI, Government of India. Yes.
Okay. So you will have first all approvals in place, and then first the open offer will be launched, and then the pref placement.
The pref will happen within 15 days of the closure of the open offer.
Okay. That's very helpful. Thanks.
Thank you.
Thank you. We'll take the next question from the line of Jayant Kharote from Axis Capital. Please go ahead.
Thank you for the opportunity. The first question is regarding the ROA question. I see that secured assets is clearly focus area incrementally. If you can call out a couple of products there where you can see that in the next 3 years, the size of such products can become, let's say, 2x, 3x, or anything that you can guide us in terms of the size. Basically, what we're trying to understand is which will be the drivers for incremental growth. If you are sitting with such large networks, you can build a size of books over there. If you can call out that is first. And second, just follow up on that. You can also tell us the ROA profile of your retail book and which products have a slightly better ROA profile.
Yeah. With regard to the growth, I'll just tell ROA, I'll ask Jaideep to answer you. See, there are the products which we have launched. You just look at the things which have grown. For example, the TBG, which is nothing but working capital and term loan for the various business groups. It just propelled beyond doubling of the business. That is one. So it will continue to grow at that rate when the new network is coming, because the opportunity we feel is pretty huge in MSME sector. And second important thing there will be a multiplicity will be in respect of liability mobilization with the distribution points getting doubled and tripled. That is one. When the distribution points grows up, it suddenly opens up a big business for all our mortgage business, wheels business, and our BVG business. All these business gold loan, which is a branch based, that is also something which will be in terms of 3x, 4x. Because the gold is somewhere in the current trend, we will be able to get into the space of some of these NBFCs which are doing it. Today we are not able to get in the space because of the lack of distribution available to us. And another very important point, what you can think about is in respect of the distribution points going to create our visibility, and it will provide us a big opportunity for the SME and commercial banking. That is something which will also be in a position to grow to 2x, 3x. And this synergy between this, the investor and the bank will also provide you a big opportunity in corporate. And the corporate will no longer be growing at what is the rate we are doing it. You would have seen the last quarter we grew around 40%, and 30% is what the corporate has grown, and commercial has grown around 32%. There you can see a large opportunity to grow at faster than what we've been growing it. While composition may remain, all the engines which we have already fired in the last 2 things have an ability to grow multiple. And now we will be looking at some of the missing parts of our retail portfolio which we have not launched like commercial vehicles. We can explore those possibilities. And apart from that, the important thing which will multiply is our ability to grow the retail deposit. Retail deposit has its own constraint by having the footprints. Today the footprint is at 561 locations. That we can have it, when the footprint increases to multifold, our ability to have the retail deposit less than 3 crores will also get spiral up. And with this, we are not looking away from corporate, from the credit cards. The credit card is another big business. We have reimagined the entire business. We have been doing with the partners with more branches available. Suddenly, our ability to mobilize from the new market will go up, and which we have totally reimagined. So, in next 1 or 2 quarters, that will become absolutely normal with a high business growth opportunity. That will enable us. Because when the business grows high, our ability to grow in the card also proportionately goes up. So is our microfinance, which is coming out of the book now, and it may not be spiraling very high, but it will be fully utilizing the capacity, and it will no longer be the only vertical which is contributing revenue, and with its CGFMU and other coverage we have taken, it will be able to sustain any down cycle. So the model what we are looking at is more capital. There will be a spiraling of the business in the normal secure and other things, which are going to give us a higher. In fact, I just made a statement that our entire sector has become a profitable PBT level. We'll ask Jaideep to tell you about all the ROE and related activities.
Yeah, Jayant, just to add to Mr. Kumar, basically, conceptually think about improving degrees of freedom, right? I mean, I think we are constrained today on cost of funds, and therefore we have certain choices on the assets. Those constraints begin to fall away. Obviously, even with the same product segment, the opportunity to grow becomes faster. So that was one. On the question on retail assets, I think tractors is very profitable for us, followed by the other small AHL and small business loans. Prime mortgages is where the spreads are narrow, and which will take some more time for profitability. But as I said, that opportunity improves because over time we will expect to become far more competitive on cost of funds as compared to, let's say, larger peers over time. And that degrees of freedom is actually what really makes a big difference because your risk-reward choices get influenced basis that.
So just if I may add a follow-up, it's clear that the strategy will be distribution-led over the next couple of years. Fair to say that even if you get an optical bump in the ROA right now, you would want to use that to invest in creating more long-term value through expanding?
That's correct.
Yes.
Absolutely.
Hello?
Jayant, can you hear us?
Hello? Yes.
Yes, sir, we can hear you.
Am I audible now?
Yeah. So the answer to your question was yes.
Okay. So any time frame, if let's say from 560 we want to go to 1500, 2000, any time frame in your mind right now?
I think it's too premature. I'll repeat the statement that we made, that this is an announcement. It will take us several months to consummate the transaction. That gives us enough time to plan.
Okay. So one more question, if I could squeeze in about the podcast. I see an inch up in the slippages in the credit card personal loan portfolio. Can we expect this to be the major part of the bulk stressed identified book, or 3Q should be a sharp improvement, or it can really still there?
No, Jayant, I think the cards portfolio slippage will take a couple of quarters to normalize. So we will be in this range, give or take, for at least 1 to 2 quarters before we start seeing things improving.
And this is largely cards, not PL, right?
They are fairly integrated in that sense. So typically PL, of course, will always be on a like-to-like basis lower than cards because PL gets cross-sold to the upper end of card customers. But when we are talking about slippages, this number is a combination of both.
Thank you and congratulations once again.
Thank you, Jayant.
Thank you. The next question is from the line of Rakesh Kumar from Valentis Advisors. Please go ahead.
Hello.
Yes, sir. Please proceed.
Yeah. Hi. Thanks for the opportunity, sir. So, sir, just a couple of questions to with. Post this, this transaction and the open offer, how would the senior management hierarchy, how would the board structure would look like?
So the board structure as per that particular transaction agreement which we have signed is be a 50-50. In a sense, 50% will be subject, of course, to RBL approval. 50% is an independent director. 50% will be the other than independent directors. So that other than independent directors will have two components. One will be executive directors and the non-executive directors. So they will have the right to nominate the executive directors and NEDs as well. Today the bank has a board of around 11. So the 11 will not work for that. So the board can be 10 or 12. It will be an even number. We have already moved for that to be amended as instead of 15, we wanted to have it cap at 14.
Okay. So net, how many representatives they would have post the transaction?
See, that is what it is. 10, 12 or 14 is going to decide that particular number. If it is a 10, you can easily calculate it with other than AD and MD, 5 and ULRT. Then other numbers are only the mathematical formula. This we have to wait and see how it is.
Got it, sir. And so senior management and top management, how that structure hierarchy, would there be any change post that? Any discussion?
Sorry, go ahead.
Sorry, sir. I said, sir, any discussion we have had so far?
Parking the discussion part out of it, I just wanted to tell that this is a senior management and the senior management which has been working. The entire group has been working together for the last 3 years to stabilize the bank, consolidate the bank, and grow the bank. And I don't find the reason that why some other team should come for scaling the bank. Since it is not going to be the other one, the take is very simple. Any investor will be liking to see that the delivery of the team, and going by that way, that the team will stay together. And you know pretty well that my given statement is always work with the team which we have been doing it. For 3 years, they demonstrated how good they are, and they will continue to grow.
True, sir. Agree with you. So second thing, I couldn't understand it, having looked at banking for last around 25 years. You said that, you will have capital and the growth will be multifold, So, hypothetically, in any large private bank, considering that they have abundant amount of seed capital, so they start growing at, very high pace. Does it look like, such an easy possibility?
Instead of making a comparison within the other banks who's already reached certain scale, I just wanted to look at this. This is Agile, the bank which is the hunger for the business. Our market share is hardly 0.5%, whereas the opportunity available is much, much larger. If I increase my distribution and we are in a position to build the capacity as we have been telling about you, this market share of 0.5 has an ability to go to 1. So when you wanted to move from 0.5 to 1, there is a huge business growth, which is possible with this kind of infusion what we are talking about, what we have agreed upon.
Got it. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Param Subramanian from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on the deal. Firstly, a lot of my questions have been answered. Firstly, again on management, will Emirates be bringing in management representatives? How do you think about that? Management?
Right now, as per the agreement which you have linked, it is a board which they are talking about. The management will continue as it is, as per the agreement I'm talking about. And we can't predict beyond 3 years or 4 years. I'm talking about the current short-term understanding what we have and what is being paid.
And fortunately, their business is quite small, right? So we don't expect any material overlap at all.
Fair enough. Okay. And secondly, see, I heard a lot about, so for example, you mentioned that your cost of deposit come down. You're also a significant part of your balance sheet will now get equity funded. So I'm presuming it allows you to expand into a lot more products now that you couldn't do earlier. So from that perspective, would it be fair to assume that over next year or next couple of years, you can grow at 30% plus? I'm just putting a number out there on your loan book. Would that number be broadly correct?
Depending on the opportunity, this is something which is global with the capacity which you have created.
Yes, so you also mentioned you're doubling, tripling of branches, expanding new products. So some rough number we can work with from a growth perspective.
The 30 is very much global. It is something global, but anyway, we'll get into the greater details and we'll take one to see that once we are ready with all the things. This probably continue another, as Jaideep said before, 5 to 6 months is a period where we'll get into much more granular. This is something we just signed the agreement yesterday. That is, we have a
Fair, yeah. Fair enough, sir. Thank you. And lastly, sir, a very significant portion of India's remittance flow comes from UAE, and you've got a market leading player as your partner. So how to think about the impact of this on your CASA overall, as in where that number can move, as in some rough numbers you could call out. I mean, I don't want a number on CASA ratio as such, but how significant this impact could be?
Param, again, I think it is really too early to talk about specific numbers on business. I think what we are comfortable in saying that the opportunities open up quite substantially on all the areas that you mentioned and more. I will again repeat, I think we've just signed the agreement. There are several steps to be taken over the next several months for closure, and we will have enough time and opportunity to get more precise at our end along with the NBD, and to also communicate that strategy going forward to other stakeholders.
Fair enough. Thank you, Sandeep. Thank you, Kumar sir. All the best and happy Diwali to everyone. Yes,
Thank you. Happy Diwali to you and to you.
Thank you. The next question is from the line of Vansh Solanki from RSPN Ventures. Please go ahead.
Hello, sir.
Yes, please proceed, sir.
Sir, my question is on the name that as we are constantly expanding now JLG book also and our wholesale book also from last many quarters expanding very well. So can we just see that our yields on advances now bottomed out, and from now on, because our books are growing, so our yields on advances will grow from now, maybe a Q3 may be a stable, Q4 will be a much improvement there, right?
Yeah, Vansh, I think we will see levers on both sides. You're right in saying that both, I will add actually that your yield on advances has bottomed out and will start moving up, primarily because of the mix. And I'm keeping any other subsequent repo cuts aside. This is a very specific answer. On the liability side, there are more levers where rate cuts will continue to flow through, and therefore, in a nutshell, we should see margins expanding from Q3 onwards. We had guided that in Q1 that we have bottomed out, and therefore Q2 is flattish, maybe just a basis points above Q1, but we are quite confident in saying that we should start improving margins from here.
And how much percentage of our deposit is because Q2 were very large, very good number of reduction in the cost of funds. So can we assume the same for Q3 onwards or what?
No, I don't think so. I think the improvement will moderate, but we still have levers on our savings account, which we will try and look at, improving on that front over time. But I don't think we will have the delta that you saw between Q2 and Q1 on cost of funds going forward. It will moderate.
Oh. Okay, and also in the write-off side, the previous question also someone asked about JLG book. So from Q1, the write-off in a JLG is in Q2. So is there any problem or on ground or what's up? It is business as usual.
No, once we have a 365-day write-off policy. If you recall, the stress in the MFI book started from Q2 of last year. So,
yes.
Actually Q3. So this is the write-off that you're seeing in Q2 is what slipped in Q3 of last year. So it's just a mathematical outcome of the slippages that we saw over the last 3-4 quarters.
Okay, sir. The last question is on the other income. I just saw that our fees income are increased in last 1 year from last Q2 also and Q1 also. But still our total other income is almost not has increased so much. There is a 13% decline YOY. So is there any other part of other income which is not increasing in that line?
No, so the two aspects to this, the treasury income, which is based on sale of GSECs and equity investment, etc., is of course, episodic, anecdotal, can't be smooth. So that is one point. And second, we answered in the beginning of the call that we have a market impact of unlisted shares that we are holding in Utkarsh Holding Company, which was approximately 40 crores. That goes as reduction in other income.
Okay. Is there any other, how can you just give me a number, how much treasury income in the current quarter and the Q1? Is there a number available?
So Q1 was a large number. Q1, because of the interest rates having come down, the trading income on GSEX was 270 odd crores in Q1. This quarter there was nothing substantial.
Okay. Thank you, sir. From my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Kiran Engineer from CLSA. Please go ahead.
Hi team. Congrats on the great deal. Just firstly, a couple of clarifications on the previous question. My line was a bit hazy. On the NIM trajectory, are we still guiding the 4.8% for the year?
Yeah, Piran, we said that we bottomed out in Q1 and therefore Q2 was flattish. We will expect from here on 10 to 15 basis points improvement every quarter. So we will continue to hold a 475 to 480 exit in March.
Perfect. And also just broadly on credit cards, now the industry, including us, has been taking a lot of portfolio actions for the last 6-7 quarters. But we still sort of continue to see slippages. And maybe I think the entire credit card industry. What do you think really are we missing here? Like why aren't the portfolio actions yielding results when it's such a short-term loan?
Yeah, I'll have Bikram answer to that.
Head of credit card.
Hi. So, the point that you're making is absolutely right. At the industry level, we see some residual stress in the customers which were already delinquent. As we have said in our previous guidance, that any time when there is a rapid issuance, so if you were to see from 2022 till 2025, there has been a rapid issuance and then some part of that cohort is still a bit painful. Now, thing with portfolio action is whatever portfolio action that we have taken is already giving us a sense of relief on fresh incidents of defaults and resolution of fresh delinquencies. The residual stress is only in delinquent or minimum paying customers in delinquent base. So, thing is that the fresh incidents of defaults have already started coming in line. We would need, at an industry level, we would need about 3 quarters to deal with the existing delinquent book.
Okay, so if you could just give us a sense if there are 100 customers who are delinquent, typically how many flow into NPA and how many flow back into standard?
So, see, this would vary from which bucket do they stay in. Typically, what we see is that customers who reach, a 4 or 5 DPD, which is, so about 90% of them get resolved. And the breakdown down is about, if we were to say that from a non-delinquent base to NPA, about 0.8% of the customers eventually land up in NPA pool.
Okay, 0.8. Fair enough. And once you land up in NPA pool, let's say after a few months you recover that money, do you reinstall the original credit limit or is it a reduced credit limit or is it zero?
Customer is typically consideration fresh, and if it is looking like a very, rarely it would be that, the restore is limit to original. Mostly either it is a reduced limit or no restart of the relationship.
Understood. Thank you. And just lastly on the open offer, Jaideep, you are explaining that if it crosses 75%, it will be toned down, the total shareholding. So just hypothetically, let's say 20% is subscribed to the open offer, then your pref issue is only 53%, is it?
No.
2% goes to for the merger.
No. So merger, first of all, is a subsequent action. So let's park that aside. The open offer gets scaled down proportionately. Both preferential and open offer amount will scale down proportionately such that the EPS goes back to 25. And then I also mentioned that because there are foreign investment in limits of 74, any reduction to comply with that will be solely on the account of preferential.
Understood. Okay. So it will be a pro rata reduction of open offer plus pref to get that theoretically 86% down to 75. It's pro rata.
That's correct.
Yes.
Absolutely.
Okay. Understood. Okay. Yeah, that's it from my end. Thank you and all the best and happy Diwali also.
Thank you.
Thank you. The next question is from the line of Krishnan ASV from HDFC Securities. Please go ahead.
Hi. Thanks for taking this question. I wish you all a very happy Diwali. Congrats on the landmark transaction. And, I'm just trying to understand a couple of things here. One, as a franchise, RBL has generally been handicapped. We have not delivered even a 14% ROE in our lifetime, right? And yet we have been able to land this transaction. This definitely augurs well for the rest of the banking system, I hope. But in terms of which handicaps can get addressed, because despite everything, NBD in its Indian avatar has not been able to do a lot. It's had a single branch. So just want to understand what capabilities is NBD likely to bring, because it's largely RBL's existing infrastructure which has to be sweated better, which has to improve its capabilities. So where are you likely to invest? So that's my first question. Number two, are there any covenants or restrictions on the existing management team that you can't, because of this golden handshake, you can't do anything?
Let me just take the first one. ENBD has an international presence, which RBL lacks. So that is the one biggest positive plus which will be in a position to be brought on table. Number two, ENBD is operating in a geography where there is a large Indian presence is there. So the Indian presence, the roots will always come back to India. So that is also going to provide a big opportunity for the RBL to reap upon. The third, there is a continuous remittance flow which comes from the GCC sector, the highest compared to the entire Indian one, that's the highest. So right now, if you ask me that RBL's share of that particular payment business is very restricted or pretty limited because of our limited geography and other things. Now, with this particular synergy which is going to bring up, there is going to be an acceptance of RBL as a bank for opening NR accounts as well as for sending the remittance back. This is going to be another synergy. The third is that they are working in a geography where the large group of our Indian corporates are dealing with, which we have been not able to deal with earlier. It is opening up a new opportunity for Indian corporates operating in geography, the corporates of UAE and GCC operating in India. So it is going to be a two-way channel which is going to provide us a bigger opportunity. And naturally, the bank distribution will expand because of, you asked about the gap. The gap was that our capital ability to raise the capital, we can do always in tranches, 1,000, 2,000, 3,000 for doing the growth of that particular period. So this is upfront, we can have a large distribution which can be created, which will catapult or multiply our ability to grow in all the areas that we have done. The second part of the question was with regard to what? Management and other things.
Covenants. In the sense, generally there have been precedents in the past, not just in India and elsewhere as well. But when financial institutions undergo landmark transactions, you want to at least address the behavioral issues. So are there any covenants that, are there any restrictions that you can't overdo certain things during the interim, that you got to run it as business as usual? How do you address that? Yeah.
No, it is pretty much business as usual. There will be some information requirements, etc., that might be required, but there is nothing which is of any significance which will have any constraint on us to live life business as usual in the interim. And of course, once the capital comes in, the opportunities that were just different.
Great. Thanks a lot. And wish you all a very happy Diwali.
Thank you. Wish you the same.
Thank you. The next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Good afternoon, everyone. Thanks for the opportunity. Sir, congratulations on this deal. Not only it is good for RBL, but even for the country. $3 billion added to the kitty. Just one question, other questions are answered. So what is the return on equity that Emirates is looking at from their investment? And any time frame by which we would be reaching those levels?
Right now, it is a growth capital which is being talked about. I think beyond as of now.
So no number as such you can share?
Shailesh, obviously the ability to draw business plans over time is still very premature. As I've said multiple times before, this is just an announcement. We will have many steps before we consummate the transaction. There will be enough time and opportunity for us to fine-tune our thinking and also communicate that to stakeholders over time. One data point, however, having said that, EMBD is running at about 90 to 20% ROE. So hopefully we'll.
That would be great. Thanks a lot. Just a small question on the quarter. What would be a write-off pool from MFI and CCA? And this quarter, the recovery seems to be less from the MFI side. It is only 9 crores. So if you can throw some light on that.
It goes in interest also. Yeah, so that was nothing unusually different from the last quarter. It is similar. And write-off is also, technical write-off is really a aging situation. So MFI gets technically written off over 365 days and cards over 120 days. So there is nothing unusual or different. The numbers reflect, in MFI's case, what would have happened 4 quarters back, and in cards case is just 120 days.
JD, what would be that pool? Means if you can quantify that pool?
In MFI?
Yeah, both.
MFI should be written off in this quarter, you are saying? Only this quarter?
In general, written off pool, just getting some gauge into the recovery if that can be accelerated, because we have done good written off in the last 12 months.
Yeah. About 1,500 crores of pool in MFI, which is being technically written off.
And how would, if you can throw some light on the recovery from this pool?
See, normally the recovery is in the range of around 0.6 to 0.8%. However, the efforts are per month. So this is something which we are working for, increasing it to the tune of somewhere 0.9 to 1 per month. And
this is also a function of the rural economy. So as the stress weans out and as things turn around, we will also hope to see the improvements in recovery over time. But it's not going to be a game changer. It's going to be this 75 basis points to 1% per annum range.
Okay, understood. Thanks a lot, and best of luck.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, we'll take the last question for today from the line of Jay Mundra from ICICI Securities. Please go ahead.
Hi, good afternoon, sir. Congratulations on the transaction. Sir, only one question. If you can share your preliminary thoughts on the ECL transition. We have had, we have portfolio which is inherently more risky, has more PD and almost very high LGD. This is the draft guidelines. If you would have, how would it impact the running credit cost and maybe the one-time transition? Thank you.
So Jay, broadly, the one-time transition should be in the range of about 6 to 8% of net worth, current net worth. Not a material number. That's one. And I think the impact on an ongoing basis would be that because in terms of credit cards, for example, we have pretty much full provisioning in 120 days. I don't see that as a material impact on an ongoing basis. I think we will have some increase in wholesale book because trade finance book gets added from a standard asset provisioning perspective. So my rough estimate should be that the 40 basis points that we have today maybe goes up to about 60 basis points.
Sir, the way I look at it is the SMA 1+2, right? While you have a large proportion of banks slipping in the current setup in credit card and MFI book, so anyway you are providing. But under ECL, you will have to provide on the fresh formation also, right? Which is also 3%, if not higher. So does that mean that you have slightly more structural credit costs in the current loan mix format?
So Jay, the point still is that, if that slips into NPA, it anyway gets taken care of in today's math at an accelerated manner. So therefore, so if theoretically we were providing, let's say, cards, this is the RBI guideline of unsecured, which is 15%, 25%, and 100% over 3 years, then yes, that would have been a material impact. So when SMA 1, SMA 2 flows into NPA, it anyway gets fully provided. So including that, I don't think there was an but Ramesh, you want to add?
No, I think, Jay, the question is, we have stage 1 provisioning which will come through for cards and MFI, which actually you could think about when you look at peers in the NBFC space who are listed, it will be something similar. Most logically, you will see some release in provisioning on the secured side, given the loss given default is much lower. And like Jaideep said, on the non-fund book in the wholesale segment, you will see some increase because of the nature of the balance. It's not on the balance sheet today for us. But that book is pretty much on the entities we do business with are very well rated. In most cases, better than the overall corporate portfolio. So that impact will be minimal. But the big delta will be on stage 1, stage 2, primarily in the unsecured businesses. And that I think would be similar to what you see for other peers in the industry.
Right. No, that helps a lot. Thank you and all the very best.
Thank you. That was the last question for today. We would now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com. I repeat, ir@rblbank.com. On behalf of RBL Bank Limited, we thank you for joining us and you may now disconnect your lines. Thank you.